Good evening. Today I'm going to take a video class on amalgamation of companies. That is AS14, Accounting Standard 14. So what is this amalgamation of companies and what are the things that we come across in amalgamation of companies? When two or more companies, when they are doing the same type of business, automatically they will involve in cutthroat competition or severe competition. So in order to every company, they'll get a limited number of business, that is limited number of customers. And they will compete with each other, thereby they cannot be in a position to acquire the complete market. So in order to acquire the complete market, what they will do is they'll come together, they'll combine together, and they'll form a new company with a view to capture the whole market or whole demand. Thereby they can be in a position to get more profits. Okay, this is nothing but the amalgamation of companies. Two or more companies, they close their businesses and they will form into a new company and take over the same type of business. Here, they have to do the same type of business, mind it. They have to do the same type of business. They should not do different types of businesses. When they do same type of business, in order to eliminate the competition, cutthroat competition, they will come together, they will combine together, and they will form a new company, and that process, we'll call that thing as amalgamation. And previously, amalgamation is different and absorption is different. Sir, what is this absorption? One company, when it takes over the business of another company, it is known as absorption. And previously, we are having this amalgamation separately and absorption separately. Now, what happened is, this absorption was included in amalgamation only. Okay, there is no separate topic or separate chapter for absorption. The amalgamation of companies only, they themselves, they have included this absorption of companies. So here, when we take into account amalgamation of companies means, don't be of that opinion that only amalgamation process will come. Absorption also will be a part and parcel of this amalgamation. And in amalgamation, two or more companies, they'll come to liquidation. They'll come to liquidation means they'll close down their businesses. They'll close down their businesses. Okay, and a new company is formed, and it will take over the business of the two companies. Here, the two companies, we will call them as transfer companies or selling companies. Okay, and the new company, we'll call them as transferee company or purchasing companies. For taking over the businesses of the transfer companies, the transferee company, they have to pay some amount, and we'll call that thing as purchase consideration. Okay, so in the later on courses, we'll come to know about this purchase consideration. And this purchase consideration you will come across when you go for acquisition of business. Already it was taught to you. Okay, when you come across acquisition of business, a purchasing business will purchase the business of another entity, business entity. Okay, the entity which is selling its business, we will call that thing as selling business, and the business purchased by entity, we will call that thing as purchasing business. There you will come across the purchase consideration, and already I told you about the different ways of purchase calculation of purchase consideration. Now in amalgamation, okay, in amalgamation, you'll come across two companies, two or more companies, mind it. Two or more companies, you will come across. When two or more companies, when they combine together and a new company is formed to take over the businesses of the two companies, we'll call that thing as amalgamation. Okay. And when one or more company takes over the business of another company, then we will call that thing as absorption. So there is a lot of difference between amalgamation and absorption. Don't be of that opinion that they're one and the same. Amalgamation of companies are different and absorption of companies are different. Though it is a part and parcel of amalgamation, the procedure is entirely different from that of amalgamation. Okay. So when you take into account the definition of amalgamation, I am giving you 3 definitions for amalgamation. Okay. And this amalgamation of companies, you will come across in AS 14, Accounting Standard 14, amalgamation of companies. What we will come across and what are the characteristics and what are the objectives of this amalgamation, all these things, and how the process is going to be happen, we will discuss in AS 14, Accounting Standard 14, amalgamation of companies. Now, I am going to give you the 3 definitions for this amalgamation. Okay, what are the 3 definitions given by definitions? According to S. Somayajulu versus Hope Pradhamini Company Limited, amalgamation is a state of things under which either 2 companies are joined so as to form a third entity, or one is absorbed into or blended with another. This is about the definition given by Somayajulu versus Hope Pradhamini Company Limited. Now, the second definition is, according to Habsburg law of England, amalgamation is the blending of 2 or more existing undertakings into one undertaking. The shareholders of each blending company becomes substantially the shareholders of the company which is to carry on the blended undertakings. There is a lot of difference between blended and blending. Blended means the transfer companies or the selling companies. Blending means the purchasing company or the transferring company. People, they must understand. Okay, different names you will come across. You can call them as selling companies. You can call them as transfer companies, or you can call them as blended companies. Okay, and when you go for purchasing company, you can call that thing as purchasing company. That is the new company, please. Don't be of that opinion, it is the old company. It is a new company. So the new company, we can call that thing as purchasing company, transferee company, or blending company. Blending. This blending company, it will take over the businesses of the blended companies and it will carry on the business. This is according to Habsburg law of England. Now coming to third, according to third one, that is AS 14, according to AS 14 of ICAI. Okay, amalgamation means an amalgamation pursuant to the provisions of Companies Act of 1956 or any other statute which may be applicable to companies. This standard issued is mandatory and effective in respect of accounting periods commencing on or after 1/4/1995. This is the third thing that we come across. Okay, an amalgamation pursuant to the provisions of the Companies Act of 1956 or any other statute which may be applicable to companies. So that is the thing. And this thing, it won't be applicable to any other types of businesses, any other forms of businesses. Only to the companies only it is applicable pursuant to the provisions of the Companies Act of 1956 or any other statute. Okay, So like that, the AS14 of ICAI, Institute of Chartered Accountants of India, they had defined this amalgamation. There also they have taken into account the blended companies and the blending companies. In simple language, I'm going to tell you about, instead of telling blended companies and blending companies, I'll tell you as transfer company and transferee company. Transfer companies, just keep that in your mind. Transfer, whenever I spell transfer, okay, it means nothing but the selling company. Keep that in your mind. Transferee company, it is nothing but the purchasing company. Okay, it is nothing but the purchasing company. Now, amalgamation, you will come across in two ways. Amalgamation in the nature of merger and amalgamation in the nature of purchase. So what is this again, sir? Okay, what is this again? You are telling that it is one and the same, but don't be of that opinion that it is one and the same. It is of two types. Amalgamation in the nature of merger, it is entirely different from that of amalgamation in the nature of purchase. And when you want to go for there, okay, you will come across two or more transfer companies and they will form into a transferee company. They will form into a transferee company. Okay. So even though you come across two or more, excuse me. Thank you. Okay, I'm sorry. Okay. Even though you come across two or more companies, okay, but the procedure to take into account is of two types: amalgamation in the nature of purchase and amalgamation in the nature of merge. So what is the differentiation and what is this merge and what is this purchase? When you want to go for this merger, okay, you will have 5 conditions. You will have 5 conditions and all the 5 conditions must be satisfied. Then only you can take that as amalgamation in the nature of merger. When one or more, when they are missing, okay, whatever it may be, the conditions that we come across, when one or more are missing, then we can say that it is nothing but amalgamation in the nature of purchase. And when you go for this amalgamation in the nature of merger and amalgamation in the nature of purchase, you will come across differentiation, please. And see, the differentiation you will come across when we go for the transferee books, that is purchasing company books. Up to that extent, both are one and the same. You have to take into account the treatment for both of them in the same way. Only when you are going for the transferee company books, then only you will come across the difference between the nature of merger as well as nature of purchase. So like this, you will come across. Okay. What are the things that we come across? What are the 5 conditions that we come across when we go for nature of merger? The first one is all the assets and liabilities of the transfer company becomes the assets and liabilities of the transferee company. That is the first one. That is, whatever it may be, the assets and liabilities of a selling company, they will automatically become the assets and liabilities of the purchasing company. That is the first condition. You should not be of that opinion that we can leave some assets, we can take some assets. If the purchasing company, mind it, if the purchasing company, if it is not taking over, then only the point will arise. Okay, if the purchasing company, when it is taking all the assets and liabilities of the transfer company or the selling company, then we have to take into account it is nothing but amalgamation in the nature of merger. That is the first condition. The second condition is shareholders of the transfer company will become the equity shareholders of transferee company. shareholders holding not less than 90% of the face value of the equity shares of the transfer company become equity shareholders of the transferee company. Okay. 90% of the face value of the share capital, whomever they are holding, they will become the shareholders of the transferee company. You will come across, okay, holding in a minute manner, in a minute way, that is limited number of shares. Say, for example, 10%, 20%. So we have to call them as minority shareholders. Here, the main thing that you come across is we should not take into account only the minority shareholders. We have to take into account the majority shareholders holding more than 90% of the share capital. Those shareholders of the transfer company will become the shareholders of the transferee company. All the minority shareholders, they must be given or they must be paid their amounts back. Okay, we should not entertain the minority shareholders into the purchasing company or the transferee company. The second condition is. Third condition is the consideration for the amalgamation receivable by those equity shareholders of the transfer company who agree to become equity shareholders of the transferee company is discharged by the transfer company only by the issue of equity shares in the transferee company, except that cash may be paid in respect of any fraction of shares. This means that, okay, the consideration, that is the purchase price, whatever the purchasing company is paying to the selling company, that purchase consideration, they must the shareholders of the transfer company, they must be discharged in the form of shares only, mainly in the form of shares only. Whatever it may be the fraction of shares, okay, they will pay in the form of cash. That is a third condition that you will come across. Okay, coming to the fourth condition. The business of transfer company is intended to be carried on by the transferee company. Whatever it may be the business of transfer company, it must be carried by the transferee company. In this context, I'm going to give you an example. Okay. If you take into account Bata Shoe Company and Action Shoes, these two people, they are selling the same product. They are doing the same. The nature of business is one and the same. There won't be any variation. Shoes business. And the Bata company is having branches. In the same way, the Action Shoes also, they are having branches. Keeping branches in different places is not the criteria place. They must be in a position to capture the complete market. The market demand must be within their hands. When they are separate, every person they are going to come in, compete with each other. That is, you will come across a unhealthy competition or severe cutthroat competition among themselves. Okay, basing on one person's actions, the other person, he will copy and he will do the business. So when they are competing with each other, no one will get a good market or whole market. There won't be any complete market demand for these two companies. So if they come together and if they form a new company, selling the same type of, doing the same type of business, that is selling the shoes only, then they can be in a position to capture the complete market. Otherwise, okay, it is better for them to go individually or independently. This is about the fourth condition that we come across. Now coming to the fifth condition that we come across. No adjustment is intended to be made in the book values of the assets and liabilities of the transfer company when they are incorporated in the financial statements of the transferee company. Now, whatever it may be, the assets and liabilities that are taken over by the transferee company, they must be shown in the financial statements as it is. There should not be any change or no adjustment should be done for that book value of assets and liabilities. As it is, the book values of assets and liabilities are to be incorporated in the financial statements of transferee company. These are the 5 conditions that we come across when we go for amalgamation in the nature of merger. And just contrast to this, okay, in the nature of purchase of a company, okay, one or more of the conditions specified is not satisfied. That is, there won't be, okay, they won't present. One or more of the conditions, whatever I told you just now, 5 conditions, okay, they won't be there. That is, they are not satisfied. In that case, we have to take that as amalgamation in the nature of purchase. That is the thing. And people, they will have this doubt. Sir, you are telling about amalgamation in the nature of merger and amalgamation in the nature of purchase. When you go for amalgamation in the nature of merger, 5 conditions, they must be satisfied. There is no compromisation. There is no compromisation in that. So then we can say that it is nothing but amalgamation in the nature of merger. When any or more of the conditions, when they are not satisfied, when they are not present, we can take that it is nothing but amalgamation in the nature of purchase. This is the difference that we come across. And another thing, another difference, I told you already that if you go for the transfer company's accounting treatment, both in merger and purchase, you will see one and the same. There won't be any distinction or there won't be any difference. But when we are going for the accounting treatment of the transferee company, then only you will come across the differentiation between nature of merger and purchase. What is the difference, sir? Whatever it may be, the accumulated losses, reserves, all those things, they must be transferred to general reserve account when you go for merger. And this general reserve, it may be a positive general reserve or a negative general reserve, but it must be shown in general reserve account only. Mind it, in case of merger. Now, when you go for purchase consideration, purchasing, okay, purchase, nature of purchase, you will come across goodwill or capital reserve. These are the 2 things that you will come across. Goodwill or capital reserve. So when you are incorporating the assets and liabilities in the purchasing company, you have to take into account the totals of debits as well as totals of credits. When the credit totals, when they are more than debit totals, the difference must be transferred to goodwill account. When debit totals are more than credit total, the difference must be transferred to capital reserve. These are the 2 things that you will come across when you go for transferee company accounting treatment in case of purchase, nature of purchase. But in case of merger, you have to transfer, compulsory you have to transfer to general reserve only. Whether general reserve may be a positive one or a negative one, compulsory you have transferred to general reserve, okay, general reserve account only. This is the second differentiation that you will come across between nature of merge and nature of purchase. Okay, now coming to purchase consideration. What is this purchase consideration? Purchase consideration is nothing but the purchase price given by the transferee company to the transfer companies for taking over the businesses. And what do you mean by businesses, sir? The assets and liabilities. The assets and liabilities. And this transferee company. Okay, when you go for the problematic portion, the purchasing company or the transferee company, it is taking the complete business. Whenever you come across the word complete business, it means all the assets and liabilities, including cash at bank and cash in hand, also you must be taken into account. You should not leave any one. And when they specify, those assets only you have to take into account. And sometimes the purchasing company, they will value the assets in the open market. So when they are valuing, you have to take into account the market values only when you are going for transferee company. But when you go for transfer company, you have to take into account only the book values. You have to take into account only the book values, but not the market values. Okay, this is the thing that people, they must understand and they must keep in their minds. And this amalgamation is very, very important from your examination point of view. Don't take it as lightest thing. It is compulsory and you will come across one question, whatever it may be the course, whether you go for UG, PG or any professional course, amalgamation is compulsory. One question you will come across from amalgamation. They won't skip. Okay, so keep this in mind and try to understand and digest this. Okay, now purchase price. Whatever it may be, the amount that was paid by the transferee company to the transfer company, will call that thing as purchase consideration or purchase price. And already we have learned this. And this purchase price or purchase consideration, after taking into account the assets and liabilities by the transferee company, then only they will pay that. Don't be of that opinion. They'll pay first of all the purchase price and then take over the assets and liabilities. After taking into account only the assets and liabilities only, they will pay the purchase consideration or purchase price. To calculate the purchase price, we are having, okay, 4 methods. We are having 4 methods. First one is lump sum method. And this method, it is at present an outdated method. People, they are not going for this. People, they are not showing any interest for this lump sum method. That is, so what is this lump sum method? Even though it is outdated, just explain us. If you say that, okay, lump sum method means by taking over the businesses of the transfer companies, the purchasing company, it will pay some lump sum amount to the transfer companies. And it is headache of the transfer companies whether they are giving their business at profitable lines or at loss. It is headache of those people. It is not the headache of the purchasing company, please. So that is nothing but lump sum method, and that method is outdated now. And what is the next method? Net assets method. What is this net assets method? They take into account all the assets of the transfer companies, all the assets, including cash at bank and cash in hand, please. And they will total them. You will get total assets. And from the total assets, whatever it may be, the outside liabilities, they will deduct that. Then the net balance, we'll call that thing as net assets or net worth or purchase consideration. Like this, you will come across net assets or purchase consideration. And think that or keep that in your mind, that when you go for net assets method, whatever it may be, the purchase consideration, it will be given in the form of shares. It will be given in the form of shares by the transferee company. And whenever there is any fraction of shares, they will pay in the form of cash. Mind it, you won't come across any long-term debts. Long-term debts. That is, the transferee company, they won't pay any debentures when we go for net assets method. We will come across only the payment, giving of just purchase price or purchase consideration in the form of shares. Okay, shares and cash or cash, like this only they will pay to the transfer company. This is about the net assets method. Now coming to net payments method. Net payments method. Okay. Yeah. There are some points to be noted, please, in this net assets method. The term all assets include cash in hand and cash at bank, but does not include fictitious assets such as profit and loss account, debit balance, preliminary expenses, underwriting commission, discount on issue of shares and debentures. These things you have to take into account, you have to note down. These are the points, main important points you'll come across when you go for net assets method. The agreed value of assets taken over should be added, but the assets not taken over by the purchasing company should not be added. The goodwill should be valued and added in assets taken over. This is the thing. Whatever it may be, the assets that are taken over by the purchasing company, those things only you have to take. The assets which are not taken over by the purchasing company, they should not be taken into account. The term liabilities means all liabilities to the third parties, that is excluding liability to shareholders. Excluding liability to shareholders. Whatever it may be, the outside liabilities that we come across, we have to take that outside liabilities only. Okay. Trade liabilities including trade creditors and bills payable, but other liabilities such as bank overdraft, debentures, tax liability, and outstanding expenses are not trade liabilities. Sometimes you'll come across trade liabilities, the word trade liabilities. When you come across trade liabilities, you'll come across trade creditors, and bills payable only. Don't keep the bank overdraft or outstanding expenses, debentures, or tax liability. All these things you should not include in trade liabilities. Only two things: trade creditors and bills payable. That is sundry creditors and bills payable only you have to include. Okay, so that is the next point to be noted. Now, whenever you come across any fund, okay, whenever you come across any fund, for example, if a fund or a part of it denotes liability to third parties, it should be included in the liability. Workmen's compensation fund. Workmen's compensation fund. Whenever you come across this, should be included. This should be included. The term liabilities does not include past accumulated profits or reserves. Whatever it may be, the reserves and whatever it may be, the accumulated profits, you have to transfer to shareholders only, but not to liabilities. That is, you should not consider them as liabilities. Even though they appear on the liability side, you should not take into account those things. Next, if any liability is not taken over by the purchasing company, it should be paid by the selling company or the transfer company only. Okay, and they should not be included in the calculation of purchase consideration. Okay, So these are the various points that you come across when you go for net assets method. Now, net payments method. This is the third method for calculation of purchase consideration. And what we will see in this, when you go for trade payment, net payments method, the transferee company, it will take into account the shares of the transfer company. And by increasing the number of shares or by increasing the face value, it will take the shares of the transfer company. It will take the shares of the transfer company. And in return, they'll pay some shares, increasing the face value or giving the same number of shares or increasing the shares, increasing in the number of shares, and sometimes in the form of debentures and sometimes cash. So when you go for net payments method, the shares of the transfer company will be taken over by the purchasing company or by the transferee company, and in return they will pay shares, debentures, cash. Okay, there is no necessity for you to take over, into account the various liabilities and assets place. So that is nothing but net payments method. And people, they must be very careful in this. Now, what are the points that we have to note down when you go for net payments method? Assets and liabilities taken over by transferee company are not to be considered. I told you already. The creditors and debentures taken over by the transferee company and subsequently discharged by it are not to be considered. Only the payment mode by the transferee company to shareholders of the transfer company in case in cash or shares should be taken in purchase consideration. That's all. And in rare circumstances, you will come across shares, debentures, and cash. But in normal conditions, in general conditions, you will come across cash and shares only when you go for net payments method. In very, very rare circumstances only, you will come across debentures. And if they mention, mind it, if they mention in the problem, you have to take that. Okay, so with this, I'm stopping, and the remaining portion I'm going to continue tomorrow. Thank you.